welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest, Adam Grimes. Adam's a frequent guest, and welcome to, always glad to have you back. So welcome, Adam.
Thank you. Sorry, I was muted there for a second.
Oh, no problem. Before we get started, just a quick disclaimer that we have Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing the level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And again, this is for educational purposes only. So I'll go ahead and stop sharing and give the ball back to you, Adam. And while we're doing that, just want to say thank you for your tactical report that comes out almost every day. That's really well written and highly useful. So I really appreciate the subscription. It's really a good thing. I'm happy to be a subscriber.
Thank you. I'm, doing that work over the past few years has, I say few years, but I guess we've been publishing for 8 years, and we've been fortunate to be on the right side of the market more often than not. And it's also, it's just been all kinds of rewarding for me. It's been to get feedback from people like yourself, and especially to hear people that where I've been able to help them kind of figure out the market and figure out their own investing style, and just to be a part of that is really, really pretty exciting. And I certainly appreciate the forum here and a chance to connect with your folks. And if, by the way, as we go through today, if anybody has any questions, hit me with those. I'll probably save questions until the end, but sometimes things that seem clear to me when I do the presentation, not so clear when I present. So if any of this sparks discussion, that's fantastic. And Tom, can you see my screen? Do we look okay?
Yeah, you look fine.
Okay, great. So let's jump right in. One of the things I've been thinking about more and more over the past few years is kind of that interesting question, why is it so hard to learn to trade, and why is it so hard to teach people to trade? And there are some objective reasons about it, but there's some objective reasons that is true. But I also think that one of the big things that gets in our way is people misunderstand the nature of trading. People misunderstand what we're trying to do and what success looks like. And of course, I've just put some things here. I realize that most of the people I'm talking to today, you don't think like this. But, most of us, when we get into the market, we kind of have this idea, and I certainly did. I didn't know any better, that we were going to find some secret pattern or, some way to, and when that doesn't work, then you think about how to kind of figure out the information before everybody else does. And there are all these ways and things that people try that don't really work. And most of us have been doing this a while. You're very aware that the solution is discipline. And how many presentations have you heard that center around discipline? How many traders have you talked to? Every interview you hear with a successful trader, the discipline, the D word pops up. And in fact, I tell people that all the time. You've got to be disciplined. It's one of the most important things. But the problem, particularly with a developing trader, is that discipline is a result of what we do as much as a goal. And that's something I've really, I've realized over the past few years, that we can write all the books we want and tell people to be disciplined, follow your trading plan. We can make all the nice pithy sayings, but unless we have the framework within which we can be disciplined, then we're not going to be disciplined traders. And that's one of the truths that I think is so often forgotten. So what is that? What is that framework? Well, when Tom asked me to do this presentation, I was thinking about what I was calling the true skills of trading. And you can see these here on the screen: psychological skills, mental skills, process skills, and then pattern recognition. All of these things fit together to, they're the framework that I have used over the years to build my success and my consistency, and I think they're also transferable. So that's what I want to talk about today. We're going to go through these skills. Let's dig right in. Psychological skills. So what are the key psychological skills of trading? It's not somehow intuiting or figuring out what the market's going to do. It's not knowing when to step up to the table and risk big, like you're in a casino or something. Really, I think what these skills are is, first of all, an acceptance of uncertainty. So much of our lives is really about removing uncertainty. We do things to be safe. We do things to give us the outcome we want. But then when we step into the market, we step into a big bucket of uncertainty. We just don't know. And a lot of the traders that I see who really struggle, this is one of the places people get stuck very early on. If you can't open yourself to the possibility of the loss, if you can't accept the uncertainty in the market, then you're always going to be struggling as a trader. Because I believe the reason is because this is one of the basic fundamental truths of the market. And with this, once I tell people the story that I had traded for well over 10 years and made more money than I'd lost, but I'd made and lost quite a bit. And I really did not feel that I mastered these psychological issues until I put on a bunch of trades in a violent market environment. And then my trading partner at the time kind of looked at me quizzically and said, "How are you going to feel if every one of these trades we just put on is a loser?" And I thought about it for a minute, and I gave him the honest answer. I said, I don't care. And he said, "Yeah, me too." That was really, and I contrast that with what I see in developing traders and what I saw in myself the first few years, which is you put on a trade and you agonize over it. You worry about what's going to happen. You say, "Oh, just let this one trade work out." And I think once you start to understand and accept the uncertainty, that confidence grows from that sense of detachment. Now, what does it mean to accept risk? So we can understand some of this intellectually, but with the psychological skills, we're really driving toward emotional outcomes. I'm going to talk about that a little bit more, but I think one of the core concepts here is accepting risk. And as options traders, you all are very familiar with thinking about risk. And in fact, risk is one of what I would consider to be the two pillars of modern finance. The first being time value of money. You give me $1 tomorrow, it's worth less than $1 today. But also the idea that investors should, and a lot of finance books will tell you do, but I don't know if that's always true, but investors certainly should demand greater return for greater risk. The problem, of course, is that measuring risk is problematic. How do people do that? This is not, if you've seen my presentations before, sometimes I will bury you under charts. This is not that type of presentation. I don't have that many charts. But here's one. You've probably seen displays like this. This is a chart of, it happens to be the Swiss franc, could have been many markets, and underneath it are two different periods of historical volatility. I think one is the 90-day, the blue slower moving is a 90-day, the faster moving is a 20-day. And we can notice some things with if you look at the 20-day, you see that it moves in these big steps. And of course, what is happening is that's an evaluation window, just like with a moving average, and it's really an artifact of the measurement. Standard finance, we measure risk as a standard deviation of returns, and historical volatility is an expression of that. So if you start talking with a lot of people or reading books, they're going to tell you that this is risk. This is how we measure the risk of the market. So we measure volatility. Of course, many of you who have taken the time to see, I'm looking at 2014 here, probably have some idea what's on the next slide, right? Let me flip back and forth. So look at the scaling of the volatility on the bottom. The top of the volatility is about 12. I page forward a little bit. This puts the end of the previous chart in the middle of this chart, and you can see here the next day the volatility goes up to 60-something. And the future is highly uncertain, much more variable than we would think with any, and in fact, this is an argument for trading options, I'm certainly aware, but with any risk management framework, you'd have had a difficult time planning for a move like this. And of course, this move happened in a matter of seconds. You're looking at daily bars here. So we need to accept that this idea of measuring volatility as risk is one type of risk, but there are other risks. We've just looked at what we consider to be tail risk, the black swan events, and that that phrase at least has kind of entered the common lexicon in the past decade or so. But this certainly does happen. In whatever market you trade, you will have anybody contemplating a career in trading. This is one of the important things to consider. You will have, it's not that it might happen, you will have these extremely large moves in the future. Other risks that I think people don't think about enough, correlation, particularly if you're trading stocks. It's very hard to have on even 5 or 6 independent positions. They're much closer to one big position. Currencies, we have correlated risk, even commodities. Of course, we seek to manage these risks, but this is something that kind of trying to shine the light on some of the risks we might miss. Others, infrastructure risk and business risk. So I would consider this being your internet going down. If you're building a trading program, you need to plan for these risks. And there have been times in my career when I've had to run someplace and use somebody else's phone. It hasn't happened in a while, but it probably will happen again. So I have here beside me on my desk a little card that has all my account numbers and broker phone numbers. And you need to plan for what could happen if you had to deal with these things. Of course, with your cell phone nowadays, we have some types of backup. Business risk: could your broker ever go out of business? Could there be some regulatory change? These last two are very, very important, and people don't think about them enough, which is kind of a recurring trope when we start thinking about risks. People many times will focus on the wrong risk. They'll focus on this trade being stopped out, and they don't think about, let's hit the bottom one, methodological risk, which is the idea that maybe what you're doing just doesn't work, doesn't have an edge. Is certainly something to consider. And also the idea of personal risk. If you're a discretionary trader or even a systematic traders are more discretionary than many people think. How are you going to handle stress, the stress of a move to a new house, a new country, the stress of real estate problems, taxes, marital problems, health, all of these, a family member having financial trouble, all of these things can kind of, it's like we're sitting in the middle of a spider web and getting all of these inputs. And it can have, and over the course of a trading career, will likely have much more of an impact than you realize at times. I hit earlier about the idea of opening yourself up to uncertainty and the possibility of a loss. I want to revisit this. And I think one of the things where I see a clear division between traders who are doing okay and traders who are struggling is this attitude toward loss. We talk about, all the disclaimers say in trading there's a possibility of a loss. Well, I actually would consider there's a certainty of a loss. If you trade, you absolutely will lose because you can't win without losing. Losing is an unavoidable part of having winning trades. And I would just encourage you, if you are at all beat up or struggling under the weight of some of your losses, rethink them as a cost of doing business. If you, for instance, if you owned a shoe store and you bought inventory, you are not going to, if you're thinking properly, you're not going to sit around and be very upset about the loss of the money you spent to buy shoes. Take any physical business, a restaurant buying food. It's simply the money you spend to get your profit in the door. And there is a very odd thing that happens when we're focused on something. We can make that outcome happen. And I've seen over and over again that traders who are obsessed with, worried about, focused on losses, it's like, have you ever been driving a car down the road and you see something on the side of the road and you look at it, and it's very interesting and it catches your attention and you keep looking at it? What will you do? Unless you're a very skilled driver, you will tend to swerve toward the thing you're looking toward. And this definitely happens in trading too. And we're focused on something, we will tend to shape our accounts in that direction. So if you struggle with worrying about losses, thinking about losses, the bad news is that I don't think you're going to have any significant success as a trader until you get right with how you think about losses. That's the bad news. The good news is the same thing, that once you can get right in how you think and how you relate to losses, you will probably find your trading makes incredible strides forward. I've seen this over and over and over. This is not just my ideas. One of the things that we do want to think about, we're going to talk a little bit more about randomness later, but if you we all go through periods of good performance and bad performance. And I have found, Tom talked about my Waverly work, and every year we publish, we've been profitable. And we will have strings of many, many months where basically it's like we can't find a losing trade. Every trade we put on is a winner and almost an instant winner. And at a previous point in my career, just to be very honest and personal here, I would have been dancing in the streets with that kind of performance, and I would have thought maybe Adam is a genius. Maybe Adam's actually solved the trading puzzle. But now I know, and I've seen this over and over and over. Even with a very consistent methodology, you will go through periods of extremely good performance, and you also go through periods of extremely bad performance. And, looking here on your screen, you will see the couple decades of statistics for a pretty decent baseball player, to say the least. But if you look at the variability from year to year, there are some years it wasn't so impressive, and there's some years that these are confidence intervals, the bars. Many of you know how to read these. There's some years that were very variable, some exceptional years, and a lot of years that kind of settle in around the average. Your trading career, if you're a good trader, is probably going to look something like this. You're going to have some great years, you're going to have some bad years, and you have to accept that. It comes in with this understanding risk and understanding loss. And I mentioned this before, that I think this point where you become detached from the possibility of a loss with this kind of I don't care attitude toward trade outcomes, at least for me, was a watershed moment. Now, just to be clear, this doesn't mean that we're irresponsible. It doesn't mean that we don't care about risk. It doesn't mean that we are just gambling. No, not at all. But I'll hit some of the process stuff later. But I think you understand how this is coming together and why it's so important. So why is all of this psychology so hard? Most traders, your typical path to trade is maybe you trade a little bit and you have some success or failures and you learn a little bit, and then you go back in the market equipped with a lot more knowledge, and you discover it's a lot harder than you thought it would be. And you think you're prepared. It certainly was my experience. You educate yourself every way you can. Maybe you do some demo trading. You create some systems. You talk to a lot of traders. You work, maybe you work with a coach or something. And then when you go in and you start trading again, you discover, wow, crap, or some other word, right? This is still a lot harder than I thought it would be. And why is that? Well, the psychological side is so hard. And I think one of the mistakes that people make, and I just want to caution against this because this idea is floating around there a lot, is that trading is purely psychological. And you'll see people who incidentally are selling trading psychology services who will tell you that trading is 100% psychological. You don't trade the market, you trade your beliefs, so all that matter are your beliefs. And you've probably heard this from several places. This is wrong. There are statistical realities in the market, and if we have the wrong beliefs that are not aligned with those realities, we're not going to make money. But trading is still very emotional, and it's an emotional experience because the market is emotional. And I realize talking to some options traders here, I'm probably talking to some pretty cerebral individuals. I'm probably talking to some pretty intellectual people. And we can approach the market with that intellectual firepower. We can approach the market as a problem to be solved, but we need to understand that the true nature of the market, the market that generates this mathematical data that we can process intellectually, it's a very emotional process. The price changes in the market are the end result of everybody who participates in the market, of their actions. Their actions include both rational analysis and emotional context. And here's one of the places, I told you where I think modern finance is correct, but here's one place where I think it is wrong. Particularly a lot of the efficient market thinking, the idea is that people get new information and they process it and they make the right decisions. Well, we know that people get new information and they process it and they try to make the best decisions for themselves, but these decisions sometimes are extremely emotional, and sometimes responses to market movements can be extremely emotional. And in this very competitive, if you after this presentation, if you have not thought about this, as you're taking a walk this evening or tomorrow, think about what would happen if you had this environment where people were trying to beat each other. It's extremely competitive, and people are making intelligent and also emotional decisions. It's very easy if you take that thought experiment forward to see that we would evolve something that would basically encourage people to do the wrong thing at the wrong time. And my belief, one of my core beliefs about the market, is that this is the reality of the market. The market has people have been trading things for a long time. And over the course of civilization, I imagine the nature of the market has not changed much. That the market has evolved to cause you, me, and you, each of us, to want to do the wrong thing at the wrong time. So we have to know that. And we have to know that the market, if we respond to what feels right in the market, many of us have experienced this, right? You actually end up doing the wrong thing. So how do we think about psychology from a practical perspective? As I said before, this is not rational. This is not intellectual. You're not going to figure it out. The work of trading psychology is primarily emotional. And one of the answers, I think, for developing traders is simply times at bat. Multiple exposures. The first time you put a trade on, you're very, very nervous. The second time, you're very, very nervous. After you put on 50 trades, it gets easier to not care. The excitement and the nervousness and the anxiety do begin to go away just simply when we're exposed to multiple trade events and trade outcomes. I also think that it is very important to find ways to reduce the financial impact of your trades to insignificance. Now, many of you are thinking right away, okay, Adam, great, but if my loss is insignificant, so is my profit. Well, I'm suggesting this as a bridge to profitability. If you're struggling as a trader, I can't tell you how many times over the years that I will talk to people who've lost what to me would be a lot of money, high 6, 7 figures, U.S. dollars, and these people are losing, have been losing for years, and they're still trading very large size. And in fact, in many cases, what are they doing? They're increasing their size to try to make their loss back. And this is what they're doing is compounding all of these psychological issues and makes everything much, much, much more difficult. So you need to find ways to reduce the trade outcomes to the point they're insignificant for you. And I also think, in a couple previous slides, I hit kind of hard on trading psychology, but I do think that this work is valuable and important. It has to be done in the framework of everything else we're doing, but many of the problems and struggles traders face are, in fact, internal. And it's appropriate to do things. What are the answers? You got to figure out how you connect with yourself, right? For some people, therapy is good, journaling is good, writing is good, doing simple things, social things, things that we enjoy, being outside, meditation, just introspection. So this work is important and certainly does have a place. I don't want you to get the idea that I think trading psychology is completely without value. That's not true. But let's shift our focus a little bit. So we've been talking about psychology, which is primarily emotional, and our emotional, instinctive animal responses to the market's movements. And the distinction I'm drawing between psychology and mental here is between emotion and intellect. This is more rational. And again, many people do, I think, misunderstand the trading problem as an intellectual exercise. One of the things that I tell people sometimes is the market's not a math problem. The problem really is that the market looks like a math problem. We get numbers, we get data, we can apply all of these great mathematical tools with varying degrees of success, but we have to remember the nature of the market is not primarily mathematical. And this is a problem if we're trying to figure this out, because one of the things Wall Street does is to use complexity as marketing. And how many Wall Street firms will hire an army of PhDs to give you the idea that you can't possibly do this yourself. So you need to give your money to somebody and then pay them to manage it, basically. There is a place for complexity, and there are spots of complexity. When you think about, for instance, the way gamma changes in response to volatility or price movement, it's a little bit of if you haven't done it before and you're thinking about the rate of change of a rate of change of potentially a rate of change, it certainly can be complex, but also very simple concepts and approaches work well in markets, and that's important to remember. I do think the mental skills of trading are important, but they're not too hard to define. So here's what I think you need to do, and this is probably more tractable. This is probably an easier problem to conquer than psychology. So I'm not going to spend time on this slide. You have to know everything there is to know about the markets you trade, how they're quoted, how you get in and out of trades, financial outcomes of trades. I talked to a trader recently who bought an option and was surprised that he lost as much money as he lost because he didn't understand pricing. So you got to understand this. This is table stakes. You can't play unless you understand this stuff, and I hope most of you do. You also need some basic math. I'm not going to spend a lot of time here, but in my opinion, over many, many, many years of doing this, I think the math boils down to a few simple things. With some dependency on the markets you trade. I think an options trader needs to understand, for instance, rates of change a little bit better and a little bit differently than, say, a directional futures trader. So there is some dependency on the markets you trade, but I think the commonalities are probability and statistics. And when I say probability, I want you to have the sense of an old, smart, successful poker player. I would rather have you have that sense than the 24-year-old PhD who understands everything theoretically about probability but doesn't understand that what it feels like, the intuitive sense of how probability works. And a lot of different ways to drive toward that. You can do it with some simulation. You can do it with a lot of trading. You can do it with a lot of thinking or setting up problems yourself. But I would suggest to you that having an academic understanding is always good and always important, but it's probably not sufficient. You're going to need a very practical understanding of probability. Now, closely related to all of this is randomness and the impact of randomness. And I've given entire presentations on this. I've written tons of blog posts on this concept, and I think you will see this is a glowing thread that certainly holds this presentation together, but I think beyond that also touches most of my other work. And randomness, well, why is it important? First of all, markets move randomly most of the time. And many traders do not believe this. Many traders struggle with this, and many traders find ways to try to deny this. But I am convinced, after both a lot of quantitative work and a lot of practical experience, that this is true. Markets are usually unpredictable, so there's usually no reason to be in a trade. Now, if you're thinking, I'm just going to go and sell options premium, let's talk about tail risk, because I've also known a number of traders who have gotten away with that. And you're very familiar with these arguments, but the argument of picking up pennies in front of a steamroller is valid. And I think that things tend to be priced fairly, and the problem is that the day of reckoning with somebody just selling a lot of naked premium, that day of reckoning may come 10, 20 years down the road, but it may come in a format that completely wipes out your net worth. So I realize that there are a lot of people out there who tell you there's simply an edge to selling premium all the time. They can show you years of back tests that show that to be true, but I am concerned that that approach hides risk that we really have a lot of trouble getting our hands around. And the reason why I went down that diversion is because that's one of the arguments. How do you trade random markets? Well, you just sell premium and hope for the best. I don't think that it's not an approach, let's say, that I'm comfortable with personally. So the game comes down to looking for spots where the market is less likely to be random. And then you have an opinion. Then you can have a reason to be in a trade. I put opinion in quotes there, but most of the time we don't. Also, randomness makes it very hard to learn. It obscures edges in the outcome. I spent a little bit of time earlier talking about runs and streaks. And here is a chart that if you've seen my work, I've used this before. This is, I believe this just models 50 runs. So the way the system worked is this imagines a trader starts with $100,000 and he trades a positive expectancy system for 250 trades. And the blue arrow off to the right side of the screen shows where the expected value for the system is. However, each of these paths is a separate Monte Carlo path through just purely random draws. Now, this was a positive expectancy system, and it's Monte Carlo, so nobody made mistakes, but look at the range of outcomes. And if you imagine, you see somebody trading this, people tell you if you have a positive expectancy system, you can't lose. Here in this example, you see a trader did, in fact, lose money trading a positive expectancy system, and many of these runs were under the starting value for quite some period of time. So even with a positive expectancy process, even with an actual edge in the market, our outcomes can still be sometimes frustratingly variable. And all of this makes it very difficult to learn. If you're training an animal, one of the best ways to make behavior permanent is a random reinforcement schedule. If you want to teach your dog to sit and you give your dog a treat every time the dog sits, that will work very efficiently. You'll get your dog to sit very quickly. And as soon as you stop giving the treat, very quickly the behavior will stop. the dog knows I'm not getting a treat, so the behavior stops. However, and this animal trainers know this very well, if you give random reinforcement, sometimes you give the treat, sometimes you don't, that behavior will be much more persistent and much closer to permanent, in fact, permanent in some cases. You can do a random reinforcement schedule and never give your dog a treat again, and the behavior is permanent. Well, the problem is that the market's reinforcement is so variable that it is almost random. How many times, those of you who have traded for any significant period of time, how many times have you done exactly the right thing? You found the best setup. The setup had an edge. You put on the right trade structure, right size. You managed the trade appropriately, and you lost. Do you know anybody who did something incredibly stupid, like loaded up their account, bought a ton of out-of-the-money options on something, and then the something moved, and they made a ton of money, and they think they're a genius trader? And this happens in the market. Our outcomes are not necessarily tied, or are not tied very tightly at all to our behaviors. And, you can also have, one of the other things that makes this very difficult is you can have extremely emotional events. You could, in that scenario where you did the right thing, you did exactly the right thing, and then the market makes a huge move against you that you could not have foreseen, and you took a large loss on the trade doing exactly the right thing. Well, that's a very emotional event, right? You're going to be angry. You're going to be hurt. All of this, it just makes for a very difficult learning environment. One of the examples that I use is imagine a teacher teaching small children, and the teacher is, let's say, borderline crazy. She'll randomly reinforce kids that get wrong answers, tell them how smart they are. She'll punish kids that do good work, but sometimes she'll do good things for the kids. And this is the way the market is. The market is very capricious, and if we focus too much on the outcome of any event, we find our emotions blown all over the place. So what's the answer? Well, all of this works toward a whole. There's no one magical solution that I can give you here, but I will tell you that part of the answer is thinking over. You don't think about one trade. You don't think about 1 week. You don't even think about a few months, depending on how frequently you trade. This example is, let's say you're a trader who holds trades for a few days to a few weeks. In that case, you're probably evaluating your trading on 6-month windows. If you're an active day trader, let's say you do 5 or 6 trades a day, then you're probably evaluating your trades over the course of a month. So you have a respectable sample size. But even if you are a day trader, many people get into day trading because they think that they will never lose. You never have a losing day, or you never have a losing week. Well, you will. And I'll tell you up front, you will. So when it happens, you won't be crushed. When you're a good, consistent daily trader, you're going to have some losing months. You may have some losing quarters. You will have some losing quarters. You may have a losing year or so in there. So you got to think over large sample sizes, but you also need a deep, intuitive understanding of both the nature of the market and the nature of the trading game. How do you get there? Well, because trading is so variable and the market is so variable, process becomes very important. And we're going to, we're going to be moving a little bit faster through some of these things. Process matters. But I guess one of the things that I would caution about, if you read the peak performance literature, and there's a lot of good stuff out there, and in fact I'm considering writing a book on the topic myself, but if you look at what are some disciplines people focus on for peak performance, sports, athletics, music, chess, academics, and most of these disciplines, things are pretty well defined. You may have in chess, you can, I think I heard a statistic, there are more ways to arrange chess pieces on a chessboard than there are stars in the galaxy. From a practical standpoint, you don't see nearly that many patterns. Things are pretty clearly defined. In music, outcomes are pretty clearly defined. In trading, gosh, we just don't know, right? And I think this is one of the things when people try to apply peak performance thinking from other disciplines to trading, they don't appreciate the variability of the trading process and trading outcomes. So understanding that and understanding why we can't rely on these short-term runs, we start to realize that big picture process is what really matters. Well, what does that mean? Well, it's a set of things we do consistently. And up front, I will tell you that there's no value to doing things consistently if they don't have a statistical edge. That's a key point. A lot of people, and we'll talk about pattern recognition here in a moment, as I said before, a lot of people will tell you, you just have to do something. You have to have a consistent process, and they will trivialize the problem of finding an edge in the market. Well, you have to have an edge. If you don't have an edge, then your process is not going to help. But assuming that you do, then assuming that you have that edge in the market, then adherence to a consistent process will give you the best chance for success. I would think of process in three broad categories. Your analytical process, how you look at the market, your trading process, how you get in and out of trades, and then your personal process. We're going to spend a little bit of time thinking about that. Market process, I don't need to belabor the point, but this is basically being a responsible trader and doing your homework. So one of the problems I see with people is that particularly in an environment like we have right now where there are a lot of political concerns, a lot of geopolitical concerns, people are really bombarded by news, and the news is very emotional. And if we're getting information in a very emotional context, it's hard to know what to do with that information. So we want to eliminate variables that are not important. And that's one of the things that I have certainly done in my work, and I think has given me the clarity to be on the right side of markets. Many people will call me and say, well, Adam, are you worried about this? What do you think about this? And they're asking me many times about things that I have, in fact, not thought about, because they're not things that I think have much power over the markets, and they're not cause for concerns. And I don't think within certain boundaries, I don't think there's anything to be lost by narrowing your focus. And in fact, there's a lot to be gained. I was at a prop firm, and I pointed this out, that there was a lot of noise. People were talking about completely random garbage. Such and such stock just touched its 7-period moving average. Well, who cares? And I raised the objection that this is just noise. This is distracting noise. And, I'm listening to a trader who's been trading for a few weeks telling me what he thinks is going to happen to the stock. I don't need to hear that. And the response was, well, imagine a general in the battlefield who'd want every possible piece of information. You'd actually be overwhelmed. You want filtered intelligence. If you looked at an unfiltered radar screen, for instance, there's so much clutter that you can't figure out what you're looking at. You need some type of filter, and you should definitely incorporate those. You need a routine, something you do every day to look at markets, to look for new opportunities. If you're a slower moving trader, maybe that can be a weekly routine, but it needs to be something you do consistently. And you can decide top down or bottom up. I'm not going to belabor that point. That's building your process, I think, is an entirely separate presentation. As far as trading process, how do you get in and out of trades? I do think a physical checklist is a very good idea. And, you think about people who do complex tasks flying an airplane, I think, is a logical example. Nuclear reactor work. People, even though they do the same thing for years and years and years, they will still have a physical checklist, and you will still go down that checklist. And this does not have to be complex. You don't need a 14-point checklist for a trade, but maybe you need a 4-point checklist. Maybe you need a 6-point checklist, and it does not hurt to print that out and actually go through and check the boxes. You also need some type of framework for tracking and evaluating your trades and decisions. So it would be a P&L tracking sheet, a journal, and this stuff is boring, right? But you're not going to be successful without it. So I would spend some time doing it. Another thing that I think most people don't think about is you probably should have some way to check your broker. And for me, it's a matter of tracking my entries and exits, calculating my P&L, but then you need to reconcile that to the broker statement and find out, why is it different? Oh, I got a dividend I didn't know about, or I paid a dividend I didn't know about. There was a split. I got a spin-off I didn't know was happening. These things happen in your accounts. Impact of financing if you're trading different currencies, and it is worth spending some time. You'll find some mistakes. I found positions missing, and I found positions that were not mine. I do not believe that reputable brokers, that they want to be as accurate with this as they can be, and in fact they are pretty accurate, but it's an accounting problem, and it's your money, so you want to track it right. You also need to be able to track your long-term performance to understand your edge. Process evolves. It's a process is a list of things we do consistently, but you need to strike a balance between growing as a trader and evolving your process and being consistent. It seems like a little bit of a contradiction, but with the right kind of evaluation, there are points, maybe a few times a year, where you can look to make some modifications in your process. But this slide is here just to remind you that process is consistency, but it also is something that evolves. And, again, I think I could spend an hour talking on a lot of these slides, but personal process is important. And this is something that I think as a younger man I did not appreciate, because you can burn the candle at both ends and not take care of yourself and just kind of power through. But I think for a long-term enduring success in the market, you got to take care of yourself. You got to eat right. You need to exercise. You need to get away from the screen and see other humans. You need to, whatever people joke about mental health breaks, but you need those. You need to, is it going to a baseball game? Is it reading a book? Is it watching, is it going to a movie? You need, is it cooking? You need to do things that, and sometimes exercise may be these things, but you need to do things that will help your state. And I also think that it's very, very important to have a plan for lifetime learning. It's one of the things that, more and more the evidence is showing that our brains, as we get older, that using our brain basically makes the brain better. And you learn another language, learn to program, do something to really stretch and challenge yourself. And put some philosophical questions down at the bottom. We won't talk about those today, but I think you should think about it. Just say that. What you find with this process and with trading in general is that the whole is truly greater than the sum of the parts. People say that about things, but in trading it is absolutely true. And one of the trading is one of those disciplines where it's impossible to say what's the most important thing. There's no most important thing, because every single thing matters. If you have one little thing not working, maybe there are 20 things you need to do to trade successfully, and if you're doing 19 of them at an A+++ level, as well as anybody could possibly do, and you have one thing that you're not doing, it's going to destroy your results, and you're probably not going to be profitable. That's one of the things that makes trading so difficult, is that all of these little things matter. And I do think that your best chance for long-term success in this business comes when your market activities align with who you are as a person, which is why I skipped over those big picture questions at the bottom of the previous slide. It's why you probably want to spend some time thinking about that and thinking about how all of the pieces fit together and who you are, why you're trading, how you're going to do it. Let's hit the last pillar here, the pattern recognition. And on some level, this is all pattern recognition. If you've been thinking, a lot of the things that I was talking about early on emotionally in your activities in the market, we always think about pattern recognition as finding patterns in the market, but it's also finding patterns in your behavior behavior and in what works for you. So there's pattern recognition that goes beyond the market. Now we're going to turn our attention specifically to the market. And the challenge with all of this pattern recognition is separating the signal from the noise. And just, again, I'm not going to belabor this point too much, but be aware, if you are a visual trader, if you're looking at charts, that you're a pattern recognition machine. We all are. It's perhaps the way we've evolved. It certainly is the way that we are made, is that we'll look at faces and, see faces in clouds. You'll see faces in wood grain. You will see human hands and arrangements of sticks or things like that. And this spins out in a lot of other ways, that we are so good at finding patterns that if the pattern doesn't exist, our brains will generally create these patterns because we aren't very well tuned to understand the randomness, and so we'll force them into patterns. You can't fight against it, but you can certainly evaluate the outcomes. And many of you probably remember several years ago, a bagel, presumably with the face of Jesus, I think sold on eBay for some ridiculous amount of money. And, it's humorous, okay, but the trading equivalent is when you think you might be facing cognitive bias. You're still probably going to experience seeing that face, but you can ask the question, what is the probability that I'm falling prey to a cognitive bias? Statistical evaluation, again, helps. And because this is a tool to look at outcomes over large sample sizes, and to have some idea of the variability in outcomes. I do want to show you a specific example here in a moment. And, I wrote a book on technical analysis, and I'm a technical trader, but yet I'm very critical of technical analysis, and particularly traditional technical analysis is a visual discipline. People looked at patterns on charts. And this grew out of a pre-data era, I'm calling it. I remember even when I started doing this work, availability of data was a problem. I went to libraries and I drew charts from some old newspapers that I found in the library. And certainly you go back to back in previous decades, 60s, 40s, 30s, when some of these people were doing the work that we now hold in such high esteem. Well, first of all, they didn't have much data. That's one of the things to think about. Some of these markets, they just had a few decades of data, and they had no access to a lot of data. So modern technical analysis relies so heavily on appeals to authority with the forefathers of technical analysis. And my concern, and I've certainly seen this carried out in testing, is that I think a lot of what traditional technical analysis teaches, I'm not going to get into this too much, but most chart patterns, Fibonacci ratios, using moving averages as support and resistance, on and on and on. I don't think there's actually a statistical edge to this. And by the way, you will hear people using these things successfully. It doesn't necessarily mean the tool is successful, right? One of the answers that I have found is to blend statistical work, quantitative work, with technical analysis. And to do this, we define patterns very precisely so we can feed them into a computer, test them. We understand that the pattern outcomes are driven by principles of the balance of mean, reversion, and momentum. And we have to be realistic, right? With any research, we're getting one particular answer, may not be the final answer. There are certainly things that we may be missing, but in my experience, this has been a pretty good answer. And the good news is once you've done this, you can then use it to kind of fuel your intuition and to work back toward a more traditional approach. I just want to show you here, this is what an actual trading edge looks like. And to many of you, this is going to be very familiar. But people have the idea that when we're talking about edges, we're talking about finding something that happens 75% of the time or something. And I guess so. This is an extension scan that I use that is very successful. And I would call your attention to two things. First of all, look at the right side. So what this shows is the range of outcomes for a fairly large sample size, thousands of events over 1, 2, 3, 4, 5, out to 20 trading days. And even though there is a small overall edge, and the red dot in line are the mean and the median, which you can see is a little bit above 0. If you squint, you can see, look at the scaling of the chart, -60 to +80%. Those are percent. So what this is saying is, there's a dot that is somewhere around almost 70% on day 16. So there was a stock that went up in this large sample 70%, 16 days after we had this extension event. There also were stocks that went down 50%. And we have this tremendous variability of outcomes. However, it's a significant edge. And if you look now, I'd call your attention back to the complicated table on the left. Look at the up and down columns. So in the brackets, that's the raw market data. So on any given day, one day after any given day, the market was up 50.56% of the time and down 48%. And there are some unchanged in there. With this signal, it's up 55% of the time and down 44%. So roughly 5%, give or take. And that is a very significant edge. That's what an edge looks like. And you can see the edge, if you go further out in time, does appear to degrade, at least in terms of probability, but the absolute edge is still there. I want to point out another thing. We're going to flip to the next chart, which is going to be another busy chart. This is the same signal to the short side. And what I've done on the right, the heavy red line that crosses 0 is the overall average for the signal. So what we see here, this is a statistically very significant, but it's still a losing signal. If you were to short, you have a strong edge here for a few days, but 20 days out, you're still underperforming the baseline, but you're actually down on the shorts. And that's something that's worth considering too, that when we're looking for, and this is not a heavily statistical presentation, but when you're looking for statistical edges, you need to look for things. You need to be aware also that you may find some things that are statistically real and significant, but you could not trade them profitably for any number of reasons. And transaction costs could be one, but here the baseline drift in stocks is another. Practical pattern recognition, immerse yourself in the data, do this really, really deep objective analysis if you can. And you can do this in Excel. It doesn't have to be complex, but also do some subjective analysis. Trust your gut. Trust your gut. I'm going to contradict myself. Trust your gut, but then assume that your gut is wrong because it's probably heavily laced with cognitive bias, and use your intuitive sense to provoke your objective analysis, and just be very suspicious of your results. That is kind of a framework that has worked for me. And I've talked about this. I'm going over this very quickly, but I've talked about this in a lot more detail in other places. So if you have questions, go ahead and type them in. I think we'll have some time for questions, kind of wrapping up here, but let's just do a quick review. I'll give you some resources you can check out. Skills of trading. This is in a different order than I presented at the beginning, but pattern recognition is really important, both market and understanding your patterns as a trader. Mental skills. It's basically knowledge. It's, quote, just knowledge, but and many of you may have come to trading pretty much having the knowledge you needed. Others, I certainly, when I started trading, there was a lot I needed to learn, and you have to define what you need to know and do the work to learn it. Psychological skills, this is a little bit harder because this can be shaped. It can be learned and shaped, but it does take time, and sometimes a little bit of a circuitous route is needed to address the psychological issues. And it all, of course, boils down to process and the D word. So discipline is the outcome of all of this. Yes, I just gave another discipline presentation, but I do think that, so what is discipline? Well, it means you're doing the right thing every time, and every single time, every interaction with the market, you are a disciplined trader. If you don't do that, you can't tell me, Adam, so like I'm disciplined like 49 times out of 50. Well, then you're not disciplined. You need to be a disciplined trader every interaction with the market. Without that, I don't think you're going to be successful, and I've listed some reasons here. But you also, for any of this to make sense, you have to have that statistical edge, and that's extremely important. Where to go from here? Well, I would ask that question, do you have an edge? Do you have a statistical edge? And then the follow-up questions, are you sure? And how do you know? And I've been doing this for a long time, and these questions still give. If you can read this slide and very casually answer yes, yes, and well, I know, fill in the blank, and you can answer these questions with a high degree of confidence, I would challenge that, because I've been doing this. I've seen good results for a long time, and I'm still not completely comfortable with, we're dealing with epistemological questions. We're at the edge of knowledge and knowledge about knowledge, and it's worth spending some time to dig into these things and to understand them. A couple resources. Check out my blog, adamhgrimes.com. I'm going to go through a little bit quickly here. I also have a podcast, which I will be relaunching soon. There's a lot of pretty exciting stuff happening. I will be launching new site within the next few weeks, and so watch my blog, my Twitter for information on that. Tom mentioned Waverly Advisors. I'm not going to market Waverly Advisors here, but I will just tell you I would love for you to take a look at my Waverly Advisors work, and if you do that, you and I will speak on the phone. That's part of the trial process. Spend a little bit of time talking about you and your trading, and it's a product that I'm very pleased with what we've been able to do, and we do give a discount to Capital Discussions folks. So please check that out if you're at all interested. And Tom, I guess this is a good point for questions. I did see one or two come in. I'm not sure how to, okay, I see them. And if you have any questions, you can also jump back on the audio here. And I realize that, thank you, I do have a problem with the title on that slide. So Daryl says, can I compare systematic repeated selling and option premium together in pennies? Couldn't this be organized and processed so that it systematically accepts such potential for loss? Okay, Daryl, I'm going to be honest. You're talking about an area where I do not have firsthand experience with systematic repeated selling of option premium. So the best answer I can give you is I don't know. That's the most honest answer I can give you. I would just encourage you to consider I would look at an event like 1987, and I would assume two things. I would assume what happens if you're on the wrong side of 1987, and what happens if it is bigger. And, and I realize that that's not a very precise stress test, but that's, I think what you are suggesting is kind of the philosophical question with these types of strategies. Do we have enough compensation for, are we being adequately compensated for the tail risk? And my suspicion is no. I don't have hard quantitative evidence to support that. I do have many anecdotes of long-time successful options traders taking gigantic career-ending hits, but those are just anecdotes. Best answer I can give you is I don't know, but if you're going to do it, I would encourage you to keep asking those questions over and over and over and find answers that you are comfortable with. Any other questions? Tom, is there anything that I should hit again or go in a little more detail?
No, I just wanted to point out, as a pilot, we use checklists all the time, and I appreciate those comments. I remember in the F4, I flew with the high-time F4 driver in the world, and he basically talked about how important it was, and if you don't use them, you start getting complacent after about, say, 800 to 1,000 hours in the jet. You stop looking at it, and that's actually what stuff can kill you. Let's say you're most vulnerable to having an accident when you start getting complacent. So the checklists are very important to follow and to have a routine with your trading, too, so you don't blow up your account.
Right. It's all of the things that you do so many times that you're kind of on muscle memory, autopilot, and you think you know. But and I went through a period of my career where I did not use checklists, and I had enough. I had enough kind of stupid, avoidable events that I just got frustrated with myself, and I said, I'm going to write this down. It's a very simple fix. And it certainly structured my trading in a way that was very good for me. So, yeah, I think it's an important thing to do.
Hey, Adam, I had one question. I know you mentioned the 1987 crash. Do you think something like that could happen again with those market circuit breakers in place we have now?
Okay, so there are two ways to think about this, and this gets a little philosophical. So I kick these kinds of questions around with trading friends all the time. So, of course, there's the possibility that we could have something absolutely catastrophic. I'm sitting here in New York City. We could have a major city bombed. We could have some event that shuts financial markets down for weeks and financial markets open. Just imagine markets are closed around the globe for 3 weeks and they open 25% of their value today is the next tick. And what are we going to do with all the derivatives that had time attached? So there are these type of what I would consider to be borderline civilization-ending events that are possible. And you have to realize, you ask, could it happen? Yes, it could happen. But then the counter argument to that is that many of these events would have such serious social and political outcomes attached that basically it's like we're all dead anyway, to flippantly trivialize it. Does it really matter? And I certainly have very intelligent trader friends who make that argument, that the types of events that I'm discussing would be so extreme that it would change things so much that from a trading perspective it doesn't really matter. From a more practical standpoint, with the circuit breakers in place, could I imagine, it doesn't happen that much anymore, but when I started trading agricultural commodities in the 90s, we had a lot of situations where markets would lock limit for days at a time. They would lock limit and then open lock limit and open lock limit, and if you were on the wrong side of it, there was just nothing you could do except go buy some horrifically inflated options if you wish. Could that happen again? Yeah, I think it could. I think this idea that I think we're entering a period. We're not entering. We are in a period of complacency that perhaps is somewhat justified. The way that we get information in and out of the markets, the way we interact with markets is so much slicker, so much more efficient. So maybe we've removed some of those risks. My deep-seated cynical suspicion is that we have not. And these types of events are events that may very well happen once in a generation, but I still think it's lurking out there. I think it's like I don't know. It's like a big earthquake someplace, and it's going to happen eventually. That's how I think about it, and you do the best you can. But I don't really have an answer. Again, I guess the honest answer is I don't know. That's the honest answer to most of these questions.
Well, it's always a discussion of should you hedge and how much should you hedge. So I was just curious what your take on that we do have circuit breakers, but obviously if you keep opening limit down every day with no chance to trade, then effectively when it is able to trade, it could effectively open down much lower.
Right, and the parallel to the circuit breakers, and the reason that I'm a little suspicious of the circuit breakers is when they changed the structures there so that you did not see so many lock limit moves, the markets actually became a lot more orderly. And there was the idea that seems to be borne out by the data that the circuit breakers were actually introducing volatility into the market. And, perhaps they're set wide enough and intelligently enough with equities that's not really a concern. But could we imagine, let's say we live in this, I'll jokingly say, zero volatility world here for a few years, and then let's say regulators start saying, our circuit breakers are like 50 bazillion standard deviations away. So we should really tighten up the circuit breakers, and then volatility comes back. You could see any number of logical steps like that where you could have circuit breakers in place that could potentially be very disruptive. So I don't know. I guess we're back to that. I just don't know.
Right. I guess the safe thing is to have some hedges in place just in case. So.
Have some hedges in place and hope they work. And, I think with particularly with the selling premium, of course, being long some type of wing structure, at least in some capacity, and considering your overall, if the deltas go to 1, your overall exposure, just being aware of that. It is certainly possible to do this with effective risk management. I think that's the only way to do it.
Right. Well, Adam, I really appreciate you coming on again, as always. And again, thank you for the Waverly Advisors. It's a great service, and I'm probably a longtime subscriber. So
Thank you. I
thank you so
certainly
much.
appreciate your support. Thank you very much.
All right. Well, Adam, I'll let you go. And thanks, everyone, for sticking with us. And we will see you next time. Thanks, Adam.
Thank you. Take care. Bye-bye.
See you.